At Crypto Insider, we track the wildest moves in crypto, keeping our finger on the pulse of every twist and turn in this unpredictable market. And this week, Shiba Inu delivered a shockwave that rippled across the entire crypto landscape, leaving both seasoned investors and newcomers stunned. Over $6.3 billion in SHIB short positions were wiped out in just a matter of days, stunning traders everywhere and sending shockwaves through trading desks worldwide. For weeks, the mood was bearish. Traders bet big on SHIB falling, borrowing tokens to sell high and buy back low, convinced the price would keep dropping. But then, the market flipped dramatically. SHIB's price surged with unexpected force, catching short sellers completely off guard and turning the tables overnight. This triggered a classic short squeeze, where rising prices forced short sellers to buy back in at higher prices, fueling even more gains and creating a feedback loop of panic and buying. The result? A financial hurricane that erased weeks of losses in just days, turning despair into euphoria for those who held on. This wasn't just numbers on a screen, it was a lesson in market psychology, risk, and the power of collective action. It showed how quickly sentiment can shift and how group behavior can drive massive moves. SHIB, often dismissed as a meme, showed it could move markets in ways that defy expectations, proving that even so-called joke coins can have real impact. We'll break down how this happened, step by step, so you can understand the forces at play. We'll explain what a short squeeze is, how forced liquidations work, and why they can create such explosive price action. And we'll look at the role of the SHIB army, the passionate community that rallies behind the coin and can move markets with their collective enthusiasm. Understanding this event gives us insight into the unpredictable nature of crypto, where volatility is the only constant and surprises lurk around every corner. The SHIB squeeze wasn't an isolated incident, it's a symptom of broader market forces, and a reminder that anything can happen in this space. In crypto, fortunes can change overnight, and even the underdogs can become market movers, rewriting the rules of the game in real time. Let's dive into the mechanics behind this explosive event, and see what lessons we can learn for the future. Welcome to the story of the great SHIB short squeeze, a tale of risk, reward, and the unstoppable force of the crypto crowd. To understand the SHIB squeeze, let's break down what it really means to short a coin, and why it's such a risky move in the world of crypto. Imagine you borrow a rare comic from a friend, sell it for $100, and hope to buy it back for less if the price drops. You're betting the value will fall so you can return the comic and keep the difference as profit. If the price falls to $70, you buy it back, return it to your friend, and pocket $30. It's a simple win. Buy low, sell high, but in reverse order. But if the price jumps to $150, you're forced to buy it back at a loss, paying more than you sold it for. That's the risk. Your losses can be unlimited if the price keeps rising. In crypto, traders do this with coins like SHIB, using leverage to amplify both their potential gains and their potential losses. Leverage means borrowing money to increase the size of your bet, which can make things even more volatile. If the price rises, instead of falls, short sellers scramble to buy back the coin before their losses get worse, driving prices even higher as they all rush in at once. This panic buying is the start of a short squeeze, a sudden surge that catches short sellers off guard and forces them to buy at any price. As more shorts are forced to close their positions, their buying adds fuel to the rally, creating a feedback loop that can send prices soaring in a matter of minutes or hours. It's a vicious cycle. Rising prices force more shorts to buy, which pushes prices up even further, trapping more traders and intensifying the squeeze. That's exactly what happened with SHIB. Bearish bets turned into a buying frenzy, and the price exploded as traders rushed to cover their positions. The feedback loop can turn what starts as a slow climb into a vertical price spike, leaving everyone stunned by how fast the market can move. Short squeezes aren't just Wall Street drama, they're a core part of crypto's wild volatility, and they can happen at any time, often when traders least expect it. When too many traders bet against a coin, the risk of a squeeze grows. High short interest is like dry tinder, one spark can set off a firestorm of buying. The SHIB event is a textbook example of how quickly the tables can turn, and how dangerous it can be to underestimate the power of the crowd. In crypto, betting against the crowd can be dangerous, especially when emotions run high and momentum takes over. Next, let's see how forced liquidations supercharged this rally, turning a simple squeeze into a full-blown market event. Short squeezes are dramatic events in the world of trading, and they get turbocharged by forced liquidations, which can send prices soaring in a matter of minutes. When traders short with leverage, they put up collateral, essentially a security deposit, that backs their risky bets. If losses mount, and the market moves against them, exchanges automatically close their positions to protect themselves from further risk. This means the exchange buys back SHIB on the open market, instantly and often in huge volumes, regardless of the current price. When SHIB's price surged, thousands of short sellers hit their liquidation price at once, triggering a chain reaction. Automated buy orders flooded the market, pushing prices even higher as more and more shorts were forced to cover. Each wave of liquidations triggered the next, creating a domino effect that rapidly accelerated the price movement. The result? A vertical price chart, driven not by news or fundamentals, but by a mechanical process feeding on itself, amplifying volatility. Billions were wiped out in minutes as the cascade intensified, leaving traders stunned and portfolios devastated. This is how leverage can turn a small spark into a raging firestorm in the world of crypto trading. The SHIB squeeze was a brutal reminder of how quickly things can spiral out of control in these volatile markets. Let's look at the numbers behind the chaos. Over $6.3 billion in SHIB derivatives were liquidated, mostly shorts. On the peak day, $2.5 billion in shorts vanished in just 24 hours. This single-day wipeout was bigger than total liquidations across all crypto on many days. SHIB's price soared over 70% in less than 48 hours, reversing weeks of losses. Long-term holders saw their fortunes rebound almost overnight. The event triggered a market-wide spike in liquidations, but SHIB stood out for its sheer scale. It was a clear battle between bulls and bears, and the bulls won decisively. The comeback wasn't just technical, it was a dramatic shift in sentiment. In crypto, the tide can turn in an instant. The SHIB army played a crucial role in this saga. While shorts bet on collapse, the community doubled down, fueling positive sentiment and buying pressure. Ongoing development like Shibarium and token burns gave real reasons for optimism. This wasn't just hype. It was a maturing ecosystem with growing utility. The community's conviction created a supply shock. Few sellers, lots of buyers. When the rally started, limited supply amplified the surge. The squeeze was more than technical. It was a clash of belief versus bearish bets. In this case, the SHIB army's faith and fundamentals won out. It's a reminder, in crypto, community can be a market-moving force. For crypto veterans, the SHIB squeeze felt familiar. Similar events happened in SHIB's 2024 rally, and even in the GameStop saga. When a strong community holds firm, short sellers are at risk. These aren't black swan events, they're part of markets where leverage and passion collide. Each squeeze teaches traders not to underestimate retail power. As long as the SHIB army stays engaged, volatility remains a real possibility. Crowded trades can quickly become targets for violent reversals. The market punishes imbalances, and history in crypto often rhymes. The SHIB event is just the latest chapter in this ongoing story. What can we learn from the SHIB squeeze? Leverage is a double-edged sword, amplifying gains and catastrophic losses. Never risk more than you can afford to lose, especially in crypto's wild swings. Community matters. The SHIB army's conviction moved markets more than any chart. Altcoins, like SHIB, are now financial battlegrounds, not just sideshows. With so many shorts cleared out, SHIB's price path may have shifted. Watch open interest and funding rates to see how traders adapt. The squeeze was more than a price spike. It was a lesson in risk, psychology, and collective action. Will this be a one-off or the start of a new era for SHIB? Let us know in the comments. For more deep dives, stay tuned to Crypto Insider.